Inflation Nation.
All Americans are feeling the pinch.
Inflation is hitting a high not seen in 4 decades and casting a dark cloud over the economic horizon. And if the rate of inflation outstrips the return on investments, then investors are effectively losing money. Knowing what to invest in during such turbulent times is particularly challenging. So we've looked at 80 years of market data, from stocks and bonds to gold and oil, to see which investments tend to perform best during high inflation. In this film, we've analysed data from 8 periods of high inflation, which we're defining as any time the US rate of inflation climbed above 5%, which has been the case in the US, UK and many European countries since late 2021. Of course, no data provides a guarantee of how assets will perform in the future, but one thing's for sure. As an investor, if you ignore the past, you're history. Here at Capital.com, we don't only provide the platform for trading and building a portfolio, we also explain the market so you can become a confident investor. So please give this video a like, comment and subscribe, and make sure your notifications are turned on. We produced a previous explainer on inflation in late 2021. During that time, the US rate was hovering between 3 and 4%. And in that video, we explained the causes of inflation and how it moves through the economy.
Inflation is on the rise.
You could describe it as panic.
To check that video out, click the link on screen now. But for now, with double-digit inflation present in many countries, we're going to analyse some time-tested strategies you could use while investing. Soviet-controlled Hungary, 1946. Monthly inflation reached an astonishing 41.9 quadrillion %. That's the highest level in history. Extremities aside, a little bit of inflation is normal. Most central banks have a target of 2%. If it gets much higher than that, central banks raise interest rates to bring it down. We've actually done a video on that recently, which you can watch by clicking the link on screen. But raising interest rates doesn't always work. Central banks have been using this lever for the last year, and yet many countries are experiencing or heading towards double-digit inflation. Let's take a look at how different asset classes have performed during periods of high inflation. Periods of soaring inflation are often triggered by rising energy prices. Typically, that's when there is a global shock affecting the supply of energy goods, like the oil crisis in the 70s.
People can no longer afford to run cars that do 12 miles to the gallon. The energy crisis is killing them.
And the current Russian-Ukraine war.
Europe's energy crisis is deepening hours after G7 leaders agreed to implement a price cap on Russian oil.
Historically, higher inflation rates are associated with better performance of energy commodities. During the last 8 periods of high inflation since 1941, energy commodities delivered average real returns, that is, net of inflation, of over 40%. They were found to be the best performer in a study of 17 asset classes by Duke University. And during the end of the Reagan and start of the Bush senior years, energy commodities offered real returns of just over 200%. In this most recent inflationary period, from June 2021 to August 2022, the real returns for Brent crude are 16% and 11% for West Texas Intermediate. So let's take a look at the relationship between returns for crude oil and inflation over the past half century. The dots on this chart show the rate of inflation versus returns for crude oil. As you can see, as the rate of inflation increases, so do the returns. During the same period, returns for natural gas showed a similar pattern to rising inflation. And in the past year alone, natural gas offered a staggering 137% return, largely due to the supply issues stemming from the war in Ukraine.
The wealthy speculate with gold articles and gold bars when the price of gold is right.
Gold has long been considered a hedge against inflation. As a real, physical asset, it can serve as an alternative currency when a country's money fails. but that image is a bit misleading.
We're rich!
Gold isn't actually a good inflation hedge for all levels of inflation. It's not until you get into double digits, and particularly above 12.5%, which is a red flag for many investors, that gold investments really do have the Midas touch. And they can act as a glittering hedge against the loss of purchasing power in fiat currencies and bonds. For example, average real returns for gold were 13% over the last 8 periods of high inflation. But we see that gold's returns skyrocketed after the end of Bretton Woods in 1971, when President Nixon severed the link between the US dollar and the precious metal. In December 1974, when inflation was almost 12.5%, real returns for gold were nearly 170%. And gold offered returns of more than 150% during the late 70s when inflation almost topped 15%. But now things have changed. During this period of high inflation, because it hasn't conclusively broken the magic double-digit mark, real returns are at negative 12.3%. And with the Fed being hawkish over hiking interest rates, the dollar is more attractive than gold for many investors. And talking about the buck, while inflation has recently been rising at the fastest pace since the 1980s, the US dollar has simultaneously grown to a 20-year high. In this current inflationary period, dollar returns are over 9%. It seems like it should be a massive economic contradiction, doesn't it? Well, the picture's complicated. The Fed's aggressive tactics compared to other central banks have made the US an attractive place for capital. And also, because energy commodities are set in dollars, rising oil and gas prices provide the greenback an edge against other currencies. But data actually shows the dollar has historically been a very poor inflation hedge. Despite its role as the world's global reserve currency, average real returns for the buck were negative during the last 4 periods of high inflation. So we can in fact say that the US dollar is currently outperforming because other factors have come into play. Bonds are often considered a safer investment than stocks, offering less volatility and steadier returns over a longer period. Some might even say they are boring. And during inflation, fixed-rate, longer-term bonds are especially unappealing. So why is that? Well, if inflation reaches rates above that of a bond's rate of return, then you are essentially stuck losing money. Let's take a look at inflation versus return since the end of the 90s. Bonds really didn't do very well. And like energy commodities and gold, returns for US Treasury bonds drop as inflation soars. This is also the case during the current phase of high inflation, where real returns have sunk to negative 25% for US Treasury bond futures. Theoretically, Treasury inflation-protected security bonds, or TIPS for short, perform better during the initial stages of inflation, but even they haven't been able to provide real positive returns as rising yields have depressed their value. Higher inflation by itself isn't necessarily bad for stock prices. That is because higher prices can boost corporate profits, especially if companies are able to pass on higher input costs to their customers via price hikes. The energy sector is possibly the most obvious example of this. So it all depends on which stocks you're investing in. Defensive stocks, which are staples that people will always buy regardless of cost, tend to weather high inflation. Healthcare performed well historically, second only to energy, with average real returns of just below zero. All other sectors that we looked at offered a negative average real return of 6% or more during the last 8 periods of high inflation to 2008. Consumer durable stands out as a key underperformer. And that's because when high inflation shrinks our real purchasing power, we stop spending money on consumer durables like electronic goods. That's why cyclical stocks, ones affected by macroeconomic events, suffer during high inflation. Let's take the last year of increasingly high inflation. energy continues to be the best performing US sector. Energy stocks increased on average 30% in real terms between June 2021 and September 2022. You'll notice utilities have also beaten inflation by rising 5% in real terms, but the current energy crisis will surely have a role to play in this. One final point. Safer value stocks have generally outperformed more glamorous growth stocks during times of high inflation, as they have the cash flow to weather the storm. I hope you enjoyed this film and found it useful for investing during times of high inflation. It's worth mentioning that no period of inflation is the same, and they have their own unique drivers. Don't forget to like this video, comment, subscribe, and click that bell to keep notifications turned on. And of course, watch our other videos on Capital.com to get more crucial trading and investment tips.